Hi everyone, welcome to the November update for the Westferry Fund. Just going to wait another few seconds while there's just another couple of people being admitted from the lobby. There we go. I think that's everyone at the moment. So thanks for joining us for the November update. As I've said before, the main purpose of these video updates is to provide an opportunity for questions. So please use either the chat function or the Q&A function. Just doing one more admission to throw any questions you have at me, and I'll try to answer them at the end. So November was a good month for the fund and evidenced what I've been trying to achieve and thought we could achieve, albeit only on a 1 month basis, meaning that the fund is set up to not be particularly correlated with the wider market. And it was one where we managed to be up 1.7% for the month, notwithstanding that the market had a bit of a pullback for the first time in a while. So the ASX 200 total return index was down 2.7% for the month, and the small ords was down 1.5%. And looking back on a 12-month basis, the Westferry fund's now grown 13.3% for the last 12 months. That's on an expectation that, or the calculations based on an assumption that there would be reinvestment of dividends. But that's 13.3% for the last 12 months versus 5.5% for the ASX 200. So obviously the ASX 200's come off a very strong period. The small ords has has continued with a very good year, notwithstanding the fact it pulled back a bit in November. It's still up 19%. But if you look at the monthly update there, you'll see that since inception, the small ords still trails the performance. And so on that 1 year basis, we're looking good, and our annualized performance since inception is looking healthy enough, certainly ahead of both of the indices which we compare ourselves to. But as I say, we're not particularly correlated, and I think it's evidence of what I suggest to people who might want to invest in the Westferry fund, is that we're useful as part of a wider portfolio because we do well over time, but we are not particularly correlated, and because of that, we can help offset some of the decline in other funds that people might hold. So we're a good sort of diversification as part of a wider portfolio. We benefited in November, particularly from the strong gains in AF Legal Group. I spoke quite a bit about that at the last monthly update, and it was good to see that the gains that we'd already achieved at that point when I did the update in early November were maintained throughout the rest of the month, and in fact have continued into this month so far. There's been good buying activity in AF Legal. I'm aware that 3 different funds, small cap, micro cap funds, are buyers in it at the moment, wanting to increase their position. And the former director who we had some disagreements with many years ago in relation to how the firm was being run, has sold his position, which I think has left us with a really strong shareholder and a supportive shareholder base in that company now. So I continue to do quite a bit of work on and off with AF Legal over the last month. We had our AGM later in the month, and the update we provided there was important. I think it wasn't marked as market sensitive, and we didn't provide guidance. But if you look at that update at the AGM in late November, for the first time, after some board discussion and with my encouragement, we took the risk of providing what we call an aspirational target in terms of where we want to achieve over the short to medium term, as we framed it. And that was a to reach 50 million in revenue, and that would lead ideally to a profit before tax of 5 million, which is certainly a 10% margin that we think we can achieve once we get to that level of revenue. Comparing that to our current level of revenue, which is 27 million last year, and we hope will be mid 30 millions in FY26. So, as I say, it's aspirational. It's not a forecast per se, but I hope it encourage some investors at least to see where we think we can hit in the short to medium term. That's definitely not a stopping point. We think the revenue can over a 5 year period can get comfortably above that, and the nature of the business is that it's levered so that the increase in revenue should also increase margin, not just dollar profit. So that was, as I say, well received, and on the back of that, it's continued well into this month. I'll just touch on the second best contributor for the month, which is Verbrek. It's a position we've had for quite a while. It's an engineering services company that does work in various sectors, a lot of sort of oil and gas work, some in relation to water and other types of infrastructure. So this can be across all sorts of industries, but they've got connection also to hopefully the growth in spending in defence and defence services. They've done really well for us. We have watched them for many years, and they've sort of underperformed. They were taken over by new management a few years ago, when the company was called Logicams. It had merged with another company in sort of a reverse takeover in a way. And the new board and CEO have taken a while. Just as I know with AFL, things can take a while to gain traction. They had done a lot of work to cut costs and to cut out some of the work that they were tendering for at too low margins. So, in fact, it was a great story of them doing what they said they would, which was to warn everyone that revenue was actually going to come down, but that they expected that to result in much higher margins and thus a much higher profit. And that's exactly what they managed to achieve. We took a position on the back of that story through one of our brokers, Veritas, who I think are really good microcap brokers. They do very bespoke sort of research on companies that no other brokers will cover. And we took a position at 6 cents a share with them. I lost a little bit of faith about a year ago when they produced a first half result that was a bit undercooked and made me a bit concerned as to how much visibility they had. The version they gave was that a lot of the forecast profit for that half was tied up in the AUKUS agreement, and as we all know, that got delayed, although it seems to be kicking along now. But they recovered with a really strong second half to last financial year, and seem to be going well so far. They were also one of our top 3 contributors last month, but this month that was on the back of their sort of AGM update. This month November, they announced an acquisition, which appeared to be a really good acquisition. These things can be hit and miss, but it was acquiring a small for Telstra, a business unit of Telstra called Alliance that crossed over with a lot of the same clients that Verbrek have. Alliance is a company doing 60 million in revenue versus Verbrek's, say, 80 million, 90 million, but earning 1 to 2% margins, versus the sort of the 10% margins that Verbrek are hitting, or high single digits at least. There seems to be a really good narrative around this that management will be able to, just through some basic synergies of doubling up of offices, closing some of those down, and some other cost savings, but also cross-selling to the same clients, because the two companies have slightly different services in terms of Alliance being much more of a tech, Internet of Things, telecommunications type of firm, which complements the more classic sort of engineering services that Verbrick do. So the story sounds really good. We'll see how it goes, but certainly it's convinced the market, given that the management of Verbrick have already shown they can take a low margin business and increase the margins. And if they do what they think or what they say they think they can do, which is to increase margins across the board to high single digits on what would now be a 140, $150 million revenue business, then the company will be worth a lot more than it even currently is. So it's, trading around 16, 17 cents currently versus that 6 cent entry price well back for us. So it's been really good. But as I say, it's worth backing them, and I think it can go a fair bit higher. The two biggest detractors we had, Kip McGrath and Harmony, seemed to fall not particularly for any good reason. Kip McGrath was uh, sold down because the former CEO, who is Storm McGrath, who's the son of the eponymous Kip McGrath, uh, was sort of ousted by a board that we, along with a number of other funds, supported, or in particular a particular board member who bought a position in the company himself and took some very decisive action to oust Storm on the basis that Kit McGrath was a company that has a really good business in Australia and the UK, generating great cash, but with franchisees who are a bit neglected, probably. And Storm's entire focus seemed to have been on taking the cash that was being generated by those business and pumping it into a pie in the sky type US business, which did show some promise at some stage, and he would argue got smashed by COVID, but which seemed to be then dead on arrival, but which the company kept pumping money into. And so the very strong decisive action was to just close that down, take the hit, take the losses, and return it to a business that's Australia, UK, and a bit South Africa based, and just put a lot more attention back in uh, the franchisees, identify the stronger franchisees, and encourage a sort of a growth in their ownership of owning a number of franchises. And that started and so far seems to be going well. It's not a particularly high growth business, but it is on the basis of that business now not being weighed down by the US losses, a really cheap business if it can keep producing what it has the last couple of years. Um, Part of our thesis also on that one, and I think it still exists, is the concept that it generates a lot more cash than the profit figures suggest. So it's got a large amount of depreciation from a very significant IT spend that occurred over the last few years, but that has come to an end. So the actual cash it's spending on CapEx now is actually significantly less than the depreciation. So the profit figure looks worse than the actual cash it's generating out. It's pumping out, I think, 4 million in free cash flow comfortably a year. And that's being sensibly allocated to buybacks. The great benefit of having the board member we put it on there is we know that won't be wasted. It will be the capital allocation will be good. Back then to why it was sold down, Storm, the guy that was ousted, basically cracked the shits it seems and sold down all of his stock and initially on market, but then in a big um, one-off uh, block trade to a fund manager we know who I think is a good investor. Um, and once that was done and people knew he was out of the market as a seller because it is quite a illiquid stock, it has bounced back quite sharply this month so far. And Harmony Corp, I'll talk about this in the concept of the wider macro picture at the moment. As I said, we don't invest on a macro basis per se. We don't really allocate because we think that the stock market overall is going to go up or down. But we certainly keep an eye on it because it affects the narrative and the mood around stocks like Harmony, which is a lender. It's uh, a fairly uh, high tech based, but ultimately a lender to uh, it's not payday loans, but not far off either. So the nature of these companies, and there's a lot of them in the ASX, is that they have benefited from a tailwind of a belief and the actual situation of interest rates falling. And yeah, as I said, the belief that that was going to continue. The big picture on a macro thing for November was a real turnaround in that view because of inflation figures that suggested that, look, the inflation is not sufficiently under control. It's too high for where the RBA would like it to be. And, even the RBA governor has subsequently come out and said they are concerned that they have, lowered interest rates too much. So futures markets and the bond curves have all changed from a situation where interest rates were forecast to continue to go down to one where, in fact, it's that the next interest rate change is more likely to be up than down, is what the market thinks. So that sort of ended the narrative that these companies would have that big tailwind. The reason it's a tailwind is simply that they've lent money out at a certain interest rate, and they borrow money, and as interest rates come down, their own lending costs immediately fall, whereas they still get the benefit of having written these longer loans at higher rates, and the opposite effect happens when interest rates start going up. So that affected sentiment on this and other companies in that space. It seems to have calmed down. Harmony's up so far for this month again, quite sharply. So um, yeah, that seems to have been a fairly temporary thing. So we are going okay again this month. We're up again so far, although it's fairly early. The small ordinaries index is down 2% this month. A bit of shakiness in the overnight um, futures market in the US because Oracle have disappointed with their um, results, and you would right to be saying, so what? Because who cares what Oracle's doing? Oracle have bizarrely become something of a bellwether in the last 6 months, maybe longer for those who follow it more closely. But they've been perhaps the most aggressive of the big tech firms in terms of their investment in AI, and to the extent that the amount of borrowing they're doing, and that's the other thing, they're borrowing to make these investments, whereas the likes of Meta and Google are just using their enormous cash piles mostly, or at least their new borrowings offset by cash. Whereas Oracle have gone hard, they've borrowed, taken more risk, therefore, and so the actual shorting of their or I don't know the terminology, I don't do it, but writing puts or whatever you want to do, shorting the bonds or shorting the insurance you can take against the bonds of Oracle has become the go-to position for those who want to short the uh, the sort of Nvidia um, pumped environment that we're in with AI. For those who believe that all this unbelievable amount of money that's being pumped into AI and data centers, into AI chips through Nvidia, etc. And Oracle basically buy these chips from Nvidia and others, and rent out servers amongst many other things. But that's where a lot of their capex is going. So people have used them as a bellwether, as a vehicle for shorting this whole concept. And when their results came out today, Australian time, I haven't looked at it closely, but clearly they were disappointing in terms of capex being much higher than people expected and it not resulting in sufficient revenue growth for their liking. So it'll be interesting to see where that goes. The history of the last 2 years has been that any sort of negative news like this gets steamrolled by bullish behavior. So that will probably be what happens. But look, we're set up, as last month showed, to bulldoze our own way through that kind of wider market sentiment and achieve our own good, consistent returns. So I'm grateful that you're all on board for that. I just want to check um, as to whether there's any chats or Q&A. Um, I don't think there's anything there unless I'm missing it. Um, so look, I'll leave it at that for this month. Um, Happy to answer any questions in relation to the calculations, and I've got a note there in the uh, document about the restatement of the unit price, the monthly report, I mean, based on an adjustment we made to the distribution. The distribution we made, which has now been paid to everyone or has been reinvested as per their election, um, was increased or resulted in quite a significant increase compared to what I thought it might have been, on the back of the large gain we made on our Nebula sale being included in FY25. And so we end up paying a 9.1% distribution for FY25. One of the good things about our gains in AF Legal for FY26 is that essentially we're recouping losses so far on AF Legal. And so and also I don't really intend to sell any at this stage, so that won't result. Those sort of gains flow through the unit price, but won't result in any realised capital gains for FY26 so far. So we benefit from the rise in the unit price without that resulting in a tax effect for us in FY26 as things currently stand. Look, that's the update for this month. Very happy to answer any questions. Brian's just sent out a question about the split between listed and unlisted. Thanks, Brad. It's actually we're sitting on the highest percentage of listed assets we had for quite a long time. So it's 50% of the fund is in ASX listed companies. We've got 7% cash and around 6% is in overseas equities. Nearly all of that is on the New Zealand Stock Exchange, where we own four companies. So, the cash and those liquid assets together add up to well over 60%, around 63%. In addition to that, we've got another 8% or so in other managed funds, which are all quite liquid. They can all be redeemed, not that we intend to, but can be redeemed if necessary, or within a month or less. So the unlisted equity and unlisted debt and some unlisted property we have is at its lowest for a while, and I intend that to be essentially a slow burn going forward. Um, I don't intend to enter into any other unlisted positions going forward. I feel we've got a really good group of unlisted assets. The two big ones being Red Whale, which is the swim school business, which I'll do a big session on in early in the new year and get the CEO to talk about that to you. And the other one being Allmain, which we've had Paul, the CEO, on discuss that. And so I'm really happy with those businesses. They will start, to develop and spit off cash over the next 12 to 24 months. Redwell has that option, but may continue to reinvest. We'll see. But yeah, they're doing well. But I've come back to a view of, and look, I suppose you could treat AF Legal as something of it's almost like a unlisted private position because we're in it for the long haul. I have no intention of selling. I'm investing on a 5 to 10 year basis minimum. There may be some M&A action at some point before that, who knows? But uh, that's one where, it's not liquid per se, and that, if I started selling that down heavily, that would no doubt panic some people. So we do have those three big positions, but yes, the rest of the fund is as liquid, more liquid than it has been for a couple of years. Excellent. Look, thanks very much for joining us, everyone. Hope you have a great Christmas and holiday period. And we'll be back in early January if any of you are around and sober and keen to tune in, I would welcome you all in the next one on the second Thursday in January. Thanks all. Bye.